The FASB recently added new disclosure requirements for items reclassified out of accumulated other comprehensive income. For calendar year public entities, these requirements are effective for Q1 2013 reporting. Welcome to KPMG's podcast on ASU 2013-2, reporting of amounts reclassified out of accumulated other comprehensive income. My name is Joe Epstein. I'm a senior manager in KPMG's Department of Professional Practice. This podcast was recorded on March 13th, 2013, and will run for approximately 8 to 10 minutes, during which time I'll cover the main provisions of the ASU, which revise the disclosure requirements for items reclassified out of accumulated other comprehensive income, and is applicable for all entities that have items of other comprehensive income. For public entities, the ASU is effective prospectively for annual periods beginning after December 15th, 2012, and interim periods within those years. So as I mentioned a moment ago, calendar year public entities will be required to provide the disclosures beginning with the first quarter of 2013. For non-public entities, the ASU is effective prospectively for annual periods beginning after December 15th, 2013, and interim and annual periods thereafter, although non-public entities are not required to provide the disclosures for interim periods. Early adoption is permitted for both public and non-public entities. You can find more information on the ASU on the Financial Reporting Network, including KPMG's Defining Issues 13-9, titled FASB Expands Disclosures for Items Reclassified Out of Accumulated Other Comprehensive Income. The defining issues include several illustrative examples that you may find helpful in following along with today's podcast. ASU 2013-2 revises the required disclosures for items reclassified out of accumulated other comprehensive income, or what we'll refer to throughout the rest of the podcast as AOCI. But it's important to remember that the ASU only impacts the disclosure of items reclassified out of AOCI. The ASU does not change what items are included in other comprehensive income, or OCI. The ASU does not change items that are to be reclassified from AOCI to net income and the timing of that reclassification. And the ASU does not change the requirement from ASU 2011-5 to present the components of net income and OCI in either a continuous statement of comprehensive income or two separate but consecutive statements. The ASU also carries forward the requirements to present separately for each component of OCI, the current period OCI, and reclassifications out of AOCI during the current reporting period, and the amount of tax expense or benefit allocated to each component of OCI, including reclassification adjustments either on the face of the financial statements or in the notes. Note that the amount of tax allocated to OCI components was not required in interim periods prior to the effective date of ASU 2013-2. However, once an entity adopts ASU 2013-2, such disclosures are required for interim as well as annual periods. Now, before we get into the details of the newly required disclosures, let's take a step back and provide a brief history of how this ASU came about. Back in 2011, the FASB issued ASU 2011-5 with the goal of increasing the prominence of comprehensive income by prohibiting presentation of comprehensive income in the statement of equity. The original provisions of ASU 2011-5 also called for retrospective application and required entities to disclose on the face of the financial statements information about AOCI reclassifications on each affected net income line item. So, for example, when a previously unrealized gain or loss on an available-for-sale security is realized due to a sale of the security or an other than temporary impairment, the effect of the reclassification would be disclosed parenthetically next to the affected caption on the face of the statement that presents net income. So next to the other expense caption, an entity might include a statement in parentheses along the lines of includes $1.5 million in AOCI reclassifications for previously unrealized gains on available-for-sale securities. Constituents raised several concerns about the cost and effort to comply with these requirements, including difficulties associated with tracking items that may have been initially reclassified to a balance sheet account, particularly because the requirements applied retrospectively. For example, defined benefit post-retirement items might be reclassified to inventory or the cost of self-constructed PP&E and may be relieved into earnings one or more periods subsequent to the reclassification out of AOCI. Constituents also raised concerns about the potential confusion the disclosure requirements could cause due to presentation on the face of the statement that reports net income. Imagine the cluttering effect that could result for an entity with multiple AOCI reclassifications: unrealized gains or losses and other than temporary impairments on available for sale securities, deferred gains or losses on cash flow hedges, CTA from foreign operations, and deferred items such as actuarial gains or losses and prior service costs from defined benefit post-retirement plans, all of which could be reclassified out of AOCI in a single period. As a result of these concerns, the FASB delayed the disclosure requirements related to AOCI reclassifications so they could reconsider the operational concerns and needs of financial statement users. In ASU 2013-2, the FASB addressed those concerns by requiring disclosure of the effects of reclassifications out of AOCI on net income line items, but only for those items that are reported in their entirety into net income in the period of reclassification. Examples would include realized gains or losses on available for sale securities reclassified from AOCI to net income at the date the securities are sold, and realized gains or losses on commodity derivative contracts when the hedged transaction affects earnings. So for each of these items, entities are required to disclose the effect of the reclassification on each line item of net income that is affected by the reclassification adjustment. If an entity only has items that are reclassified out of AOCI and into net income in their entirety, this information may be provided either in the notes or parenthetically on the face of the statement that reports net income, as long as all of the information is disclosed in a single location. However, if an entity has items that are not reclassified in their entirety into net income, it is prohibited from disclosing the information parenthetically on the face of the statement that reports net income, and must present the information in the notes along with a cross-reference to other required U.S. GAAP disclosures for the items not reclassified into net income in their entirety. For example, an entity would include a description of the item, such as amortization of prior service costs related to a defined benefit post-retirement plan that would be reclassified out of AOCI and capitalized as inventory or internal use software, the amount reclassified out of AOCI, and a note that states the item is included in the computation of net periodic pension costs, and refer the reader to the Pensions and Other Post-Retirement Benefit Plan footnote for additional information. While tabular presentation of the notes is not required, an entity with multiple items not reclassified in their entirety into net income may find the tabular presentation easier for users to follow. Our Defining Issues 13-9, which is available on the Financial Reporting Network, includes some illustrative examples that you may find useful in helping to understand and visualize the new disclosure requirements. As we discussed at the beginning of the podcast, the ASU's disclosure requirements apply prospectively, with early adoption permitted for both public and non-public entities. For public entities, the disclosures are required for annual reporting periods beginning after December 15, 2012, and interim periods within those years. So that means for calendar year public entities, the disclosures would be provided starting with the first quarter of 2013. This includes disclosures about the effects of reclassifications out of AOCI on net income. During interim periods, public entities are still required to provide a cross-reference to other required U.S. GAAP disclosures for items not reclassified in their entirety into net income, even though the footnote being referenced may contain less information during interim periods compared to annual periods. The pension footnote is a good example where there may be multiple pages of the footnote in the annual financial statements, but a condensed disclosure in interim periods.